Welcome to Market Pulse. This discovery changed the way I trade candle ranges. While analyzing the 30-minute chart, I pinpointed a promising candle range to trade. But here's where it gets interesting. As I zoomed into the lower time frames to find the perfect entry, I uncovered an order block that delivered a smooth and reliable profit. What's exciting is that this strategy doesn't just work for me. You can spot these same setups in your own charts. Want to know exactly how I found this candle using the CRT model and identified this order block? Stay tuned, because I'm sharing every detail so you can apply it in your trading right away. Let's turn your trades into wins together. We're sure you know that after accumulation and manipulation, the price will trade in the distribution phase. But did you know that effectively trading the distribution phase all starts with identifying the right candle for accumulation and correctly spotting manipulation? All you need to do is find the right candle and trade it. As per my experience, bullish candles that form within downtrends or bearish candles within uptrends are often the best range candles for trading the CRT model, if they meet three specific conditions that we'll cover shortly. However, these candles can also act as a double-edged sword if not analyzed correctly. So why are these candles special? These candles are important because they appear within a strong dominant trend. After forming, the price tends to move within its range before breaking out to continue in the same direction as the dominant trend. To succeed in trading, you must understand how the market behaves in different phases. Think of the market as a cycle that moves through accumulation, manipulation, and finally, the distribution phase. In simple terms, these phases represent how traders and investors react to price changes and market activity. Now, here's an important idea. To trade successfully during the distribution phase, you first need to correctly understand and trade the earlier phases, particularly accumulation and manipulation. Why? Because these phases set the stage for what happens next. They give you clues about where the price might go. In a single bullish bar or candle, the opening price represents the start of the accumulation phase. When the price briefly drops below the opening level, some traders may believe the market is heading lower. However, this is where smart money is quietly preparing to go long. This initial drop below the opening price is part of what we call the manipulation phase. It tricks less experienced traders into thinking the price is going lower, prompting them to open short positions. These traders end up on the wrong side of the market. The smart money takes advantage of this manipulation phase to accumulate long orders, while sellers are temporarily entering short and pushing the price lower. This is the critical area where smart money positions themselves for a bullish move. Now we can clearly identify the manipulation phase as the moment when the price runs below the opening level. For us, this is the ideal phase to execute our entry orders and align with the smart money strategy. Let's take a closer look and explore these two essential phases in more detail to better understand their importance and how they work. So, how does the accumulation phase work? The accumulation phase, as the name suggests, is a period of consolidation where the price doesn't follow a clear trend. During this phase, the price moves within a range, forming equal highs and lows while gathering sell stops, buy stops, and liquidity above or below these levels. The market appears slow, with no major movements, but this is when experienced traders quietly buy or sell in preparation for the next big move. For example, during a downtrend, the formation of a bullish candle in a 15-minute timeframe chart can make some traders think the downtrend is about to end. In the lower time frame, we can observe these traders might execute a long order above the bullish candle close. As more long orders gather at this high, an accumulation phase begins. This slow buildup often signals that a bigger move is being prepared. Why do we need to spot manipulation? Market manipulation happens when big players, like banks or institutions, make sudden moves to confuse smaller traders. After a period of price stability, they might quickly push prices up or down to break below or above these liquidity levels to trick traders into buying or selling by triggering their stop orders. But don't worry, once you spot these tricks, you can avoid their trap and turn their moves to your advantage. Here's an example. To trap smaller traders, a market maker might push the price higher in the continuation. Here we can observe it as this wick. This move activates the long orders that have been building above this candle's close. But here's the catch. This action leaves many traders stuck on the wrong side of the market. By spotting this manipulation early, you can avoid being trapped and take smarter positions instead. Finally, the distribution phase. In the distribution phase, the market reaches a high point and prices begin to stabilize or reverse. This is your opportunity to profit, but only if you've correctly understood the previous phases and the right candle signals. The CRT model gives you the confidence to act during this critical phase. But here is a common mistake. Many traders, either through bad advice or learning from unreliable sources, believe they should place their trade orders during the distribution phase. But let me tell you, that's a costly mistake. Let's break it down. Imagine you've done your homework and successfully identified the accumulation and manipulation phases. Now, if you wait around for the distribution phase to take action, you've already missed the boat. By the time the distribution phase happens, the opportunity is gone and the trade is no longer viable. This is a clear example of how the candle range theory can present a valuable trade opportunity. Now, let's take a closer look at how this scenario might have unfolded if we had approached it using the classic trading methods. After correctly identifying the accumulation and manipulation phases, we observe that when the price returns to the accumulation phase on a lower time frame, it is likely entering the distribution phase. At this point, we can look for a chance to execute a short order if we spot an order block or another valid entry signal. However, on the 5-minute chart, no entry signal appears. To refine our analysis, we check a lower time frame. On the 3-minute chart, we find a classic order block, validated by a fair value gap. Unfortunately, the price moves away without activating our order, leaving this golden opportunity without profit. So, what's the solution? The secret is this. You should execute your trades during the manipulation phase. In the 1-minute time frame chart, the market demonstrated its alignment with my concept by respecting this technique. This is where the magic happens. These 3 order block entries confirm it and serve as the key to staying ahead of the market. To make this work, you'll need my order block entry method, a technique I've explained step by step in a dedicated video. This method is a game changer, and in the next part, I'll show you how it's helped me achieve consistent results. But now let's pick up where we left off and dive deeper into the strategy that focuses on the 3 key conditions we promised to cover. Imagine the market is trending upward and the price is steadily moving toward a new high. Along the way, every bearish, downward candle that forms within this uptrend could present a trade opportunity. Why? Because before the price reaches that high, it has to move through the range of this bearish candle. This creates a chance for us to enter the market by trading the range of this candle. However, there's a catch. This strategy is a double-edged sword. While these bearish candle ranges may allow us to benefit from a continuation toward the highs, the formation of a bearish candle inside an uptrend can also indicate a potential trend reversal. That's why it's crucial to check for warning signs before jumping into the trade. Here are the key patterns to watch for that might suggest the trend is about to reverse. Reversal candle violation. In an uptrend, a reversal candle violation occurs when the price completely trades through the body of a bullish candle and breaks decisively below its opening. This movement indicates a potential change in momentum or market sentiment, signaling the trend might shift. In a downtrend, a reversal candle violation occurs when the price completely trades through the body of a bearish candle and breaks decisively above its closing. This movement indicates a potential change in momentum or market sentiment, signaling the trend might shift. Break below the previous low. If the bearish candle closes with its body, not just the wick, below the low of the previous low, this can be a strong sign that the uptrend is losing strength and reversing direction. Liquidity, the engine driving market movement. In the world of trading, liquidity is like fuel. It powers every price movement in the market. Think of it as the energy source that keeps the market alive and moving. When a bearish, downward candle begins its journey from a crucial liquidity zone, such as buy-side liquidity or other major liquidity pockets, it has the potential to spark a trend reversal. By keeping an eye on these liquidity zones, you can anticipate potential reversals and make more informed trading decisions. Remember, liquidity isn't just a concept, it's the hidden force that shapes market trends. By keeping these signals in mind, you can make more informed trading decisions, minimizing risks and maximizing opportunities. These signals aren't just limited to bearish candles and uptrends. They work just as well for bullish candles forming within a downtrend. Now, let's get back to our bearish candle. If you carefully analyze it and find no signs of a trend reversal, then you're in business. The range of that candle becomes your golden trade opportunity. Once you've identified this opportunity, it's time to bring the CRT trading plan into action. This plan will guide you through executing the trade and maximizing your potential for success. We've already covered how to choose the right candle and confirm a profitable CRT trade opportunity. Great progress so far. Now we will discuss how to trade this candle range. Before diving into the second part, don't forget to like this video if you found it helpful. Take a moment to relax, grab a cup of tea, and recharge. Once you're refreshed, get ready for the second part. In CRT trading, the term candlestick refers to a three-candle pattern that embodies the power of three. This pattern highlights three key phases of market behavior. Accumulation, the phase where the market quietly builds momentum. Manipulation, a deceptive move designed to trap traders in the wrong direction. Distribution, the final phase where the price moves decisively, creating opportunities for traders. Previously, we explored how to identify the accumulation phase, a crucial starting point in the CRT framework. Now, it's time to dive into the next step, correctly recognizing the manipulation phase using the surpassing range rule. What is the surpassing range rule? The surpassing range rule is one of the simplest and most effective CRT patterns to identify manipulation. Here's how it works. Once you've identified the accumulation phase, shift your focus to the second candle. For manipulation to be confirmed, the second candle must close inside the range of the accumulation candle, but its wick must surpass the range. Why is this important? This specific candle behavior signals the market's attempt to mislead traders, a hallmark of the manipulation phase. Recognizing this pattern allows you to avoid being trapped and positions you for the next step, capitalizing on the distribution phase. By mastering the surpassing range rule, you're not just identifying market behavior, you're staying ahead of it. When the second candle breaks the rules. In the CRT framework, the second candle's behavior is key to identifying the manipulation phase. But what if the second candle surpasses the range with its body instead of just the wick? Here's what it means. If the body of the second candle breaks out of the range, it no longer fits the criteria for the manipulation phase. Instead, this behavior suggests something different, a potential trend continuation. Why this matters? When the second candle closes outside the range with its body, it's signaling momentum in the current trend rather than manipulation. Recognizing this shift is crucial because it helps you avoid trading CRT in the wrong way. Misinterpreting this signal could lead to costly mistakes, so understanding this distinction keeps your strategy on the right track. By staying sharp and observing this rule, you can sidestep errors and align your trades with the actual market behavior. And finally, the flexibility of the CRT model. The beauty of the CRT model lies in its flexibility. It's not restricted to a simple 3-candle sequence. Instead, the CRT pattern can evolve through a series of multiple candles, adapting to various market scenarios while maintaining its core principles. How does it work? Let's break it down with an example. First, the price forms a range candle, which sets the stage for the pattern. This is followed by an inside bar, where the price consolidates within the range, creating the accumulation phase. Next, we see a sweeping candle, where the price dips below the range with a shadow, or wick, signaling manipulation. Finally, the price builds momentum, forming a series of candles until it reaches the highest point of the initial range candle, the distribution phase in action. Why is this important? This extended sequence showcases the CRT model's adaptability. It emphasizes that even when the market moves in complex patterns, the same principles of accumulation, manipulation, and distribution hold true. By recognizing these formations, you can apply the CRT framework with confidence, no matter how many candles it takes for the price to complete its cycle. The CRT model's versatility makes it a powerful tool for navigating dynamic market conditions, giving you the edge to adapt your strategy in real time. It is time to open the real chart and apply all that we learn on the chart. In the past few weeks, the Euro-USD chart has shown a strong downward movement, but the price seems to have stopped at this point. Based on my experience, if the price immediately reaches 50% of the fair value gap, it is highly likely to reverse direction right away. Now that I understand the price is moving in a downtrend, I can apply any entry strategy to capitalize on this trading opportunity. For example, let's examine the bullish candles for 3 key conditions. The first bullish candle violates its previous candle. According to the reversal candle violation condition, we cannot trade this candle. However, we can observe that this bullish candle reaches almost its liquidity target, which is the 50% level of the fair value gap. This serves as a strong signal indicating the continuation of the downtrend. To refine our approach, we can search for entry opportunities in lower time frames. On the 15-minute chart, there are no viable entries, and the same applies to the 5-minute and 3-minute charts. Finally, on the 1-minute time frame, we can identify a clear order block entry. The second bullish candle follows the same pattern, but there is a key difference. This candle reaches equal highs, which acts as the target. This creates a strong accumulation and manipulation phase. Now, we can look for entry opportunities in lower time frames. On the 15-minute chart, we can clearly see a valid order block. The third candle satisfies all the required conditions, allowing us to proceed with the trade. We will find the order block entry in the 3-minute time frame chart. If you want to learn more about these order blocks and this strategy, stay tuned. In the coming days, we'll share real chart examples of this method in our upcoming videos.